Have you ever wondered why the moment you turn 65, your taxes suddenly seem more complicated instead of easier? Most retirees assume that reaching 65 means the government automatically gives them every tax break they deserve. That is exactly what catches millions of people off guard. The IRS changes the way it treats you the moment you reach this age, but almost none of those changes come with a personal notification. If you do not know what changed, you could spend years paying taxes you never actually owed. Welcome back to the Paranism. Today, we are breaking down 10 major IRS changes that happen once you turn 65, what they actually mean, and how to make sure they work in your favor instead of quietly draining your retirement savings. Stay until the end because the final rule catches almost everyone by surprise, and it could qualify you for tax benefits a full year earlier than you think. The day you celebrate your 65th birthday, the IRS quietly rewrites part of your tax picture. Nothing dramatic happens on the surface. Nobody mails you a congratulations letter explaining the new rules. Your bank does not call you. Your employer probably says nothing. Yet behind the scenes, your tax deductions become more generous, if you actually know how to claim them. The first change is your standard deduction. Once you are 65, the IRS allows you to claim an additional age-based standard deduction on top of the normal amount. For tax year 2026, a single filer receives an extra $2,000. Married couples where both spouses are at least 65 each receive an additional $1,600, giving them a combined increase of $3,200. That may not sound life-changing at first glance, but those extra deductions reduce the amount of income that is exposed to federal taxes. In practical terms, thousands of dollars simply disappear from your taxable income before the IRS even starts calculating what you owe. The problem is that countless seniors never actually realize this benefit exists. Many trust software to calculate everything automatically, while others hand their paperwork to a tax preparer without ever asking what deductions are being claimed. They receive a refund or a tax bill without understanding why. Some people pay someone hundreds of dollars to prepare a tax return, then never bother learning what is actually on it. That is like paying a mechanic to fix your car without caring whether he replaced the engine or just washed the windshield. The second major change is even bigger. Beginning with the 2025 tax year, Congress introduced a temporary senior bonus deduction. Every taxpayer who is 65 or older receives an additional $4,000 deduction. Married couples where both spouses qualify can claim $8,000 together. This bonus stacks on top of your regular standard deduction and your age-related deduction. That means many retirees can shield well over $20,000 of income if filing individually, while qualifying married couples can protect nearly $36,000 before federal income tax even enters the conversation. For many retirees living primarily on Social Security, modest pensions, or retirement withdrawals, this can completely eliminate their federal income tax liability. Yet millions continue having taxes withheld from retirement payments simply because nobody ever updated the paperwork. Remember that this senior bonus deduction is temporary. Under current law, it expires after the 2028 tax year. Every year it remains available is another opportunity to legally reduce your tax bill. Missing even 1 year means voluntarily leaving money behind. The third change involves Social Security, and this is where many retirees unknowingly create problems for themselves. The IRS does not simply look at your Social Security benefit by itself. Instead, it calculates something called provisional income, combining several different income sources to determine whether your benefits become taxable. If your provisional income remains below certain thresholds, your Social Security may escape federal taxation entirely. Cross those limits, however, and suddenly as much as 85% of your benefit can become taxable. What surprises many retirees is what counts toward provisional income. Traditional IRA withdrawals count. Pension payments count. Even interest from tax-exempt municipal bonds enters the calculation. A single withdrawal taken at the wrong time can push someone into a higher bracket and trigger taxes on benefits that had previously been tax-free. Some retirees celebrate pulling extra money from their IRA for a vacation, then act shocked when the IRS sends the bill later. Congratulations, you accidentally invited taxes to join your cruise. Turning 65 is not only about claiming deductions. It is also the point where several retirement accounts begin operating under completely different rules. If you continue treating them the same way you did while working, expensive mistakes can follow. One of the biggest traps involves health savings accounts, commonly known as HSAs. During your working years, HSAs provide valuable tax advantages because contributions reduce taxable income while withdrawals for qualified medical expenses remain tax-free. However, once you enroll in any part of Medicare, your eligibility to contribute ends immediately. This catches many people off guard because Medicare enrollment is not always as straightforward as they expect. Someone may delay Medicare while continuing to work, assuming they can safely keep contributing to an HSA. Later, after applying for Social Security, Medicare Part A is often applied retroactively for as much as 6 months. Suddenly, contributions made during that retroactive period become excess contributions. The IRS treats those excess contributions seriously. Instead of simply asking you to remove the money, it applies a 6% excise tax every year until the mistake is corrected. What looked like smart retirement planning suddenly becomes an ongoing tax penalty. The next rule involves catch-up retirement contributions. If you continue working after 65 and contribute to a 401k, the IRS allows additional catch-up contributions beyond the standard annual limit. For 2026, most workers age 64 and older qualify for the regular catch-up contribution of $8,000. Those between ages 60 and 63 receive an even larger temporary catch-up amount of $11,250. That short window from age 60 through 63 offers one of the best opportunities to accelerate retirement savings before the higher limit disappears. Traditional IRAs also allow smaller catch-up contributions, giving older workers another opportunity to strengthen retirement balances before leaving the workforce. Unfortunately, many workers ignore these opportunities because retirement feels close enough already. Instead of maximizing tax-advantaged savings during their highest earning years, they postpone contributions and later wonder why their retirement accounts never reached the balance they expected. Waiting until retirement to start getting serious about retirement planning makes about as much sense as buying a parachute after you have already jumped out of the airplane. Another important milestone is the approach of required minimum distributions, commonly called RMDs. Although RMDs generally do not begin until age 73 under current law, the years between 65 and 73 are incredibly valuable. Many retirees have already stopped earning employment income, but mandatory withdrawals have not yet started. This creates a rare planning opportunity. With lower taxable income during these years, many retirees can convert portions of their traditional IRA into a Roth IRA while remaining in relatively favorable tax brackets. Once required minimum distributions begin, those mandatory withdrawals increase taxable income whether you need the money or not. The flexibility disappears and Roth conversions often become significantly more expensive. Planning during this window can reduce future tax bills, lower taxable retirement income, and even decrease future taxes on Social Security benefits. Finally, there is one rule that does not begin immediately at 65, but deserves attention long before it arrives. Beginning at age 70 and a half, retirees may use qualified charitable distributions directly from an IRA. Rather than withdrawing funds and then donating them, eligible retirees can transfer money directly from the IRA to qualified charities. Those transfers count toward required minimum distributions while avoiding taxable income altogether. Lower adjusted gross income can also reduce Social Security taxation and potentially help limit Medicare premium surcharges later. Planning ahead allows retirees who regularly support churches or charities to make those gifts in one of the most tax-efficient ways available under current law.